All right. Before we move on, one of the things that I just realized, I updated all this and I reposted the slides for Chapter 8 because I started on it and I started realizing that I didn't give you an indication of whether higher is better. So remember, when we're talking about income versus revenues, we're talking about how much are we getting to keep out of every dollar in revenues. So in that particular case, higher is better. All right? Then, same thing here for corporate, higher is better as well. That doesn't change with that ratio. When we're talking about an average room rate, again, remember, this is going to give you like a dollar amount. So it's going to give you $75, $90, $100. And again, how much people are paying for our rooms, higher is better. Okay? All right? Same thing with RevPAR. RevPAR is going to give you a dollar amount per room, like $50, $55, $60. So again, how much people are paying for the rooms? Higher is better. Okay? Then when we're looking at occupancy percentage, again, how many room nights are occupied versus how many are available, again, the more people that are coming in, buying our rooms, higher is better. Okay? When we're looking at average food or beverage check, again, we're talking about revenues per paying guest. Higher is better. The more that they're buying, the better off we are. Okay? Now, then it shifts over when we're talking about the food and beverage cost percentage. When we're talking about percentage of cost, now we want to keep costs as low as possible per $1 of revenue. So in this case, lower is better. Okay? Then we've got our labor cost percentage. Same thing here. We want to keep costs low, so lower is better here. All right? Prime cost percentage. Remember, that's just those two combined together, total cost of sales versus the payroll. So again, cost, we want to keep it low, so lower is better. All right? Now, this one, don't let this one throw you off. When we're looking at this inventory turnover ratio, remember that inventory turnover ratio is going to give you the number of times that inventory has turned over. So again, this is going to be that ratio where if the inventory turnover ratio ends up being 52, we've turned over our inventory how often? Once a week. If we've turned it over if it comes up to a ratio of 12, we've turned it every month. Okay? If it comes up to 26, we've turned it every 2 weeks.
Where do you get the average food
Okay, that average food or beverage inventory, that's going to be a calculated number, and you're going to need the balance sheet for that one. Okay? Oh, hang on, that's liabilities. There we go. All right, you're going to need a 2-year comparative balance sheet to calculate that. And exactly. All right, so on the exam, you're going to have a comparative balance sheet. Okay. Now, all the dollar change and percent change, that won't be there, but you will have the first 2 columns here. The first thing to remember is this: look at the dates at the tops of those columns and make absolutely certain that you understand which year we are in and which year we're calculating for. Because again, you could get a question of calculate something for 20x1 or calculate it for 20x2. Okay, so that's the first thing that applies. But when we're doing this specific ratio here, we're going to come up here to this inventory amount, and you're going to have multiple inventory accounts. You'll have a food inventory, a beverage inventory, maybe a supplies inventory, something like that. So make sure that you choose the correct one. If we're evaluating the food inventory, we need to pull just food. If we're doing food and beverage, we would need to combine those together. If we're doing only beverage. Correct. Okay. So in this particular case, we take 11,000 plus 10,143, add them together, divide by 2 to get average inventory. So again, it's beginning plus ending divided by 2. But again, don't let the beginning thing throw you off. Last year's ending inventory is this year's beginning inventory. Okay? It's just a matter of verbiage as to the description of it. Okay? So in this particular case, again, remember, higher is better. So if we have a turnover ratio of 52, excellent, we're turning our inventory every week, versus if we have an inventory turnover ratio of 12, that means we're only turning it once a month. Okay? Now, here's the other thing to realize. If we are evaluating cost of food, okay, and we're doing food inventory turnover, okay, you should you know this intuitively, you just may not realize that you know it. One, when we're doing food and we've got a restaurant that does fresh food from scratch, we should have probably an inventory turnover ratio of, I would say, at least, or maybe no more than a week, right? Because the truck backs up to the dock once a week and unloads all of our produce and product and everything else that we're going to use for that week, right? We may even turn it twice a week, okay? So maybe like 104 times per year, right? So that's on the fresh food part of it, okay? But if we're evaluating beverage, think beverage, beer, liquor, wine, all of that has a shelf life of much longer than a week. So our beverage turnover ratio would be much lower than it would be for the fresh foods. Okay? So it's just the character of the type of inventory that we're getting in that makes a difference here. Okay? So if we had a beverage inventory turnover ratio of 52, that seems a little high to me. And when you think about it, most of the time, the pricing that you're going to get for food and beverage is the more you buy, the less expensive it gets per ounce, per pound, per whatever, right? So if we're doing all these little small deliveries every week, we're probably paying more overall for that product that we're buying for the bar area than if we got with our distributor and said, hey, you know what? Let's do every 2 weeks. Let's do a larger delivery every 2 weeks, and then they're probably going to charge less for the actual product that you're buying simply because they don't have to show up every week. Does that make sense? Because again, you're constantly having to think in the background, contain costs, contain costs, contain costs, and then on the front end of it towards the customer, you're thinking, keep quality high, keep quality high, keep quality high, right? So you got to balance those two things together. Okay. All right. Now remember, inventory turnover ratio, higher is better, but when we get to days inventory on hand, when we take those turnover ratios, divide them, use that as a divisor and divide it into 365, now we're talking about lower is better. So again, remember, if we end up with a turnover ratio of 52, this is going to be somewhere around 7. If we end up with a turnover ratio of 26, this ratio is going to end up being somewhere around 14. Okay? So again, number of times. Once a month is going to be a turnover ratio of 12. This is going to be around 30. Okay? So again, you'll get that picture going in your head. I think I put it on the last slide deck for the balance sheet ratio analysis, where 12 equals 30 days, 52 equals 7 days, etc. Then that way you can kind of get a feel for it. Because that way, if you get a feel for what is correct, then if you're sitting there on the exam, again, you got to remember stress and everything else plays into your thought process, you can stop and, evaluate the answer that you got. And if you got somewhere, you got an inventory turnover ratio of 12 and you ended up with a days on hand of 45, you should stop and think, okay, wait a minute. If we're flipping it 12 times a year, that's once a month. It's like, why is my turnover, my days on hand 45? And then you can very quickly, figure out what you did wrong there. Okay. All right. There are some popular income statement ratios. These last three, but realize this again. These ratios are used a lot by corporate analysts, okay, and for bankers, okay. These next three ratios are not going to be performance ratios that are going to necessarily help you run your business better. These ratios will get better if you run your business better, okay? All right, so the next one is the return on equity ratio, okay? Now, think about what's happening here. One, we're taking total net income. That's going to come from the bottom of the income statement, okay? And then we're going to do an average equity. Now, remember, average equity, that's a beginning plus ending divided by 2, just like the inventory turnover ratio. So we're simply going to take the 1,068,662 plus the 1,028,118. Add those together, divide by 2 for average equity. Okay. So when we are looking at this, what we're really trying to get a feel for when we're calculating this ratio is how many dollars of net income are we producing for every dollar that we have in equity. Okay, so we are looking at how much these folks down here, they gave us their money, they're allowing us to use it. How well are we providing a return for them? Because the higher that this ratio goes, it's an indication that we'll actually be able to pay dividends and get some return back to the stockholders. Okay? So in this case, it's a percentage, so higher is better. The more net income that we produce per dollar of equity, the better. All right, then the next one is an earnings per share. Now, an earnings per share, this is going to actually give you a dollar amount, okay? So it's simply total net income divided by the average number of common stock shares outstanding. So again, average common stock shares outstanding, that's going to be beginning plus ending divided by 2. And you would pull that, if you remember back from that balance sheet that we looked at last term, that common stock issued, there was a lot of extra little information out there, right? There was a number of stock issued and there was a number of stock authorized, right? So if you were calculating this ratio, is it issued, is it shares issued or authorized? Shares issued. Okay? So we're looking at, because think, shares issued, hang on, there we go. Shares issued is actually what affects this common stock issued and the additional paid-in capital, right? Because the more shares that we issue, the higher those two are going to get, right? Which is then going to affect total shareholder equity. Okay? All those stock, all that stock that's authorized but not issued doesn't affect our equity section at all. Okay? So again, earnings per share, higher is better. Because how many dollars are we producing in net income for the average number of shares that are outstanding, okay, or issued? Okay. Now this next one, take the earnings per share that we just calculated and we divide that into the market price per share. Now again, this is mostly investors that are going to look at this, and what we use is, they generally call this a PE ratio, okay? So you'll hear PE ratio a lot. They won't say price earnings ratio. But what we're trying to determine is the multiplier at which our stock is trading based on the earnings per share that we just calculated. So, think about what's happening here. If our earnings per share came in at $1 and the market price of our stock was $10, what's going to be our ratio here? 10, right? So what we're saying is for every dollar that we are producing for the earnings per share, for every dollar, investors are willing to pay 10 times that for the actual value of the stock, okay? Now, the higher this ratio gets, the better, because that's an indicator that we are doing something really well. So let's say that our earnings per share is still $1, but the market price of our stock is 15, right? This ratio would come in at 15, which again would tell us the shareholders are willing to pay more for our stock than maybe somebody else's. So let's say, for instance, this one is a ratio that we generally use in industry to compare businesses within the same industry. Comparing this with outside of different industries. So if you took like the hospitality industry and compared a PE ratio for the construction industry, two totally different types of industries, very, very different, whole different mindset of how they function and all that. So you wouldn't necessarily compare a PE ratio between, let's say, a pharmaceutical company and hospitality.
Is the market price always going to be like given to us somewhere? Like,
the market price would have to be given to you. Okay. Now, in real world situations, the market price we can just simply go out to NASDAQ or Wall Street Journal or whatever and look up the current market price.
but it's not going to be anything below that.
No. Market price is always something that you'll look up. Whatever the stock is trading for in the market for that day. So you can see the PE ratio will change and will fluctuate up and down multiple times every day because the market price of the stock will actually change throughout the day. Right? So we could open, and our stock could open at $8 a share this morning, but maybe, I don't know, maybe we make an announcement, everybody thinks it's great and, has a positive outlook on our company, and by the end of the day, our market price is $10 a share, right? So every time that market price per share changes, we're going to have a change in the PE ratio. Okay. All right. I went ahead and put the Chapter 8 workbook solutions out there for you. So I highly recommend that you go ahead and knock out this Chapter 8 homework before you go back. Because again, this is one of those things, you're not going to think about it. I know you're not going to want to open your accounting book over the break. And when you come back, it's just going to be a complete blank. All right? Yeah, exactly. Go ahead and get that quiz knocked out as well. Again, you know what? Let me do this. I won't be able to record it, but I want to go ahead and give you an idea of what's going to be on the remainder of the exam. Right.